Hey everybody, Preston Brent here with our Trader User Group. I'm real happy to put together this compilation of some of the webinar education series that we run throughout the course of the year. In this series here, you'll see 4 or 5 different snapshots of some of the things that we go through, some of the things that I go through. Most of our webinar series, like vertical spreads or iron condors or butterflies or futures or other various strategies, diagonals and things like that, they run anywhere from 5 to 15 hours time total over the course of a couple of months, and I really enjoy putting them together, and I think our members really love seeing them. But anyway, just go through, sit back, and just watch this 25-minute or so snippet of some of the things that we do, and then I'll pick you up on the back end side of the video. Thanks. Out of the way, why don't we just jump in the particulars? Let's jump into options. Option review, just real quick before we jump into this. It's pretty basic stuff, but I know we got a couple of basic folks out there, so I want to make sure that you understand it. Long calls, basically, are the right to buy. Expectation is bullish. It's a debit trade, so when you hear me say it's a debit trade, you got to pay to play. It's going to cost you money to put that trade on, just a long call. Long put is also a debit trade. You got to pay to play. You've got a right, however, to sell. Okay, so remember, with a call, it's a right to buy. Put, it's a right to sell. Expectation, of course, is bearish. Now, if we come over here and we go the opposite of a long call, which is a short call, now you've got an obligation. It's an obligation to sell. Think of a covered call position, essentially. All right, expectation is bearish. You expect the stock to move away from your short position, and it's a credit trade. We call that. You get paid to play. And then, of course, you got the short put. Again, it's an obligation, but now it's the opposite of a long put. Here you got an obligation to buy. Expectation is bullish. It's a credit trade. You get paid to play. So just a couple of really quick notes here on this. You can see real quick on all the short positions here. You basically have obligations, all right, which means you've got no choice. You've got to do what you got to do. You've got an obligation. You remember, you're the seller. You're selling something, so you've got to honor whoever's buying what you're selling. Okay, if you are just the opposite, if you're long something, you're the buyer, then you've got rights. You don't necessarily have to exercise those rights, but you do have rights. So that pretty much nets out at a very high level all the various combinations of calls and puts: long call, short call, long put, short put. Now, from this forms the basis of just about everything that you can do. We haven't included equities or futures, of course, right now, but this forms just about all the fun things that you can do with a lot of different option strategies, depending on how you marry calls and puts, both long and short, and then strike price, and then the expiration period. When we throw in stock or we throw in futures, and depending on how we set these up, we can create synthetic positions, which we will talk about in part 2. It gets really exciting. But for part 1, just understand these are the basics. So why don't we go in and let's take a look at option pricing theory. And again, when you make money at an accelerating rate, meaning it's moving in your direction. And when you lose money, meaning if you're long a call, it moves down, or if you're long a put, it moves up. If you lose money at a decelerating rate. That's the best position to be in, okay? So that gives you the movement of delta and how these two are affected. Now let's add one other little thing to this. Let's talk about, hey everybody, welcome to another Trader User Group edition of our evening webinar series. This is part 2 for trading option volatility. I'm glad you guys are able to join us tonight. Now, one of the things that we said, as I said, I walked through the Greeks with you, but I just kind of summarized it for you here in a nice little chart. So you can see here, depending on whether you are long or short any particular security, if you are long a stock, right, your delta position is always positive. But notice here you have no gamma, theta, or vega with stock. Same thing if you're short stock, you've got a negative delta position. But again, you have no gamma, theta, and vega. So again, as I said before, when folks first come into trading options, really they come to it from the stock world. And this is all they're used to, stock. In fact, maybe only about 5% of just stock traders really short stock. Most traders are this way right here. They just buy stock. So basically, you've got a stock, again, let's call it IBM. And over the course of 1 year, we're looking at volatility now, not price. The high for IBM for the year, you know, let's call it 35%, right? And let's call it the low of 11%. That is the historical historical volatility of IBM for 1 year, okay? Now, if we go look at IBM right now, and let's say the volatility of IBM right now is right in this area right here. You know, let's say we plot it on a curve, and that's where it is right now, okay? So if we were to put it out there, let's say, well, right now it looks like it's at 13%, okay? So if we knew that the prior year of IBM, this is the range of volatility, and right now IBM's vol is at 13, you could just eyeball that and say, well, gee, guys, is the volatility based on where it's been, is that high or low? You'd say, oh, damn, Brent, it's low. It's down here, right? Because if we were to divide this up in quarters, you know, you'd probably have, you know, some kind of gizmo that would look like this, I guess. You know, you'd have some kind of quarterly segments of this guy that would look like this, right? You'd have quartiles, essentially. And some systems do quartiles. Some do not. Well, I don't want that choose. Let's choose a different color here. So you've got right here like that right there. So, and as volatility moves through these quartiles, you know, you can say, well, gee, depending on where this guy is right here, how do I want to play it, right? This could be sitting at volatility of, I don't know, 17%, right? This could be sitting at 24%, and this could be sitting at 32% vol, right? So, and every time, each one of these represents a specific point in time, right? This is a date, that's a date, that's a date, and that's a date, sometime out there in the future. Pick up a couple of things that you weren't aware of before, but it'll all be recorded, so you'll be able to go back and play these things at any time at your leisure. But in part one this evening, foundational, and this is so important for diagonals. We're going to just review in general option spreads and the rationale of putting on an option spread. We're going to look at a spread construction, just overview of spread constructions. Then we're going to get into the Greeks. Delta, gamma, theta, vega, and rho. And with some option trades, Greeks are not as important as others. Now, I think Greeks are extremely important, but with diagonals, they're very important. You're going to find as you start to learn how to trade diagonals, diagonals are one of the most sophisticated option trades. There's a reason, and for most people that are looking to get into iron condors to trade for income, where they want to hit a certain amount of money every month, then this is an area where this is why these particular underlying securities are very popular. So we're going to spend some time on that. And then we're going to talk about iron condor execution. What I mean by iron condor execution is just that. How do you execute a trade? How do you get into a trade? So we're going to go through that in some detail tonight. And then there's probably some misconceptions that many of you may have around the execution of an iron condor. So we're going to go through that tonight as well. And then after this, part 3, we'll pick up in probably the second week of January, do the weekly holidays next week. We're going to get into, now that we've executed a condor and we've got it active, we're then going to go into trade management and trade adjustment in part 3. So part 3 is going to take everything that we built on in part 1 and part 2, and then we're going to wrap it up with part 3, trade management and adjustment. And then I'm probably going to add a part 4, and we'll actually go through some more condors, and then we'll kind of touch on weeklies and how you can possibly use weeklies, and how weekly iron condors may be just a little bit more sensitive, and you may want to trade them a little bit differently than you do monthlies. So I can see this thing going on through the end of January. So you guys, I think you'll certainly enjoy the series, and it'll be probably 5 hours or so of 6 hours or so of iron condor information. So my goal is at the end of this process, you'll know fairly well how to trade iron condors. All right, so that's the agenda for this evening. And as always, all of these sessions are always recorded, ideally at the peak of the maximum profit. So if the price expires, or if the underlying underlying security finishes in here, then both the bull put spread and the bear call spread expire, and then you collect your maximum profit. When we get into the trade management side, you will see that most successful long-term iron condor traders do not trade it that way. And we'll get into that in part 3. But that is the ideal scenario right there. Also, with an iron condor, and it's called iron because you're mixing both the puts and the calls together. That's the only reason why you call it an iron, is that you can. It is a low-cost trade, and it's a low-yield trade. So ideally, you want to set this up so that you can do anywhere from, let's say, 5 to 15% a month. 15% is a really good home run month. 5% is probably more believable. I can tell you longer term, if you can set these up where you're consistently popping 5 a month, that's about 60% of 60, and I'm talking net, not gross, net of commissions. You're doing 5% a month. That is a home run. Condor traders, kind of fun, advanced topics, some intermediate topics, just a basic understanding of Greeks. You understand what they are and how they work. Same thing with verticals. Now, we'll talk briefly about them tonight as we structure a butterfly, but you just need to have some basic understanding around these. We're going to talk about some of the benefits of why would you do a spread versus just buying a call or buying a put. Okay, I mean, what's the difference between them? And why would you do a spread versus not doing a spread? Then we're going to jump into the spread structure. We're going to define it. You know, what is it? You know, what's the general nomenclature when you define these spread structures? And then after we've talked about these, then we're going to jump into building a butterfly. And we're going to build a couple of different kinds of butterflies. We're going to do a long call fly. We're going to do a long put fly. And then we're going to do a long iron fly. So we're going to build the variety that's the most common, the calls, the puts, and then the iron butterflies. And I'm not talking about the band either. Then we're going to finish that up with the structures of the butterflies with some of the butterfly variations. We're going to look at the unbalanced fly. And then we're going to look at the broken wing fly. And then we're going to talk about the butterfly summary. So what we're doing this evening, folks, leading into this nice holiday weekend, is we're going to set the structure for the butterflies so that going forward in part 2 and then probably part 3 and even maybe part 4, we'll have a really good working knowledge of what the flies are. And when I talk about these things, you'll know instantly what we mean. We'll also go into part 2 or part 3. We'll probably talk about the short flies as well. Because most people are used to doing long butterflies. Very few people use short flies, and short flies is a volatility strategy. It's a way to play volatility, but and they're very useful at times to do. And we're going to talk about putting these on in components as well as in combined. And if you look at a long call butterfly here, you'll see here this afternoon I just went in around 3 o'clock. I took a look at Apple. and I did a long call butterfly, and what I did was I chose the 655, 665, and 675. So I did a 10 strike wide, and Apple was sitting here, you know, right at about 665, 666 area, right in this area here when I did the trade. And you can see right here a couple of things. One, the cost of the spread was very cheap. This was a September spread. It's going to expire in about 22 days. So it was a very inexpensive, or 23 days, very inexpensive trade to do. You can see my break evens down here, so this is why it gives you the look and feel of a butterfly and why they named it this way. So I'm using calls, very inexpensive to use, no margin required. I can only lose $505, and it was using 5 here with Apple. Now, if we do this again, but let's do this with the puts. If we take a look at the puts here, you're going to see by constructing, we're going to do the same strikes, all right? We're going to do 100, 105, 110, only we're going to do $5 and the other's $500. Then take the one that's the cheapest. But I can tell you, having done this a number of times, very rarely will you get a price difference more than 10 or 15 bucks. And remember, this is Apple. This is a $650 stock. If you get it even tighter, there's almost no difference. But even with a $650 stock using 10 wide strikes, it was still only maybe $10 difference. So it's basically synthetically equal to each other with the same. Now, there are instances where you would want to use a call rather than a put and vice versa. We'll get into that when we get into the tactical side of it, because you do have a choice. You can say, I'll use a call or I'll use a put. Which one do you use? So that's how those two are constructed. They're very much alike. Now, let's add one more to it. Let's add the long iron butterfly. It's a sexy term, but it's all you're really doing now is you're combining a bear call spread with a bull put spread. All right. So what you're doing is you're basically putting these two together. You're putting these credit spreads together, and you've got an iron butterfly. All right. So now you've got you're still short 2 at the 105, and you know you're long 1 and you're long 1. So you've got the same structure, right? You're long 1, you're short 2, and you're long 1. Same thing that you've got up here. So the structure is exactly alike. The exact same structure. You're just mixing and matching the calls and the puts. Now, how many of you guys think this is going to look exactly like that? Put your hands up if you think they're going to look exactly alike. All right, how many of you think it's not going to look alike? How many of you think it's going to be different? All right, so we got about half and half. Let's go take a look at it. Here is a long iron butterfly. All right, long iron butterfly, the exact same strikes. I tried to do it at the same time of day. Apple, by the way, didn't vary more than about 20 or 30 cents during that time frame. It was kind of a quiet afternoon. You can see right here, I'm short 65s. I'm long 75. I'm short 55s, and I'm long, or I'm short 5 of the 65. So this is an iron butterfly constructed the same way. All right. And you can see here how this thing looks on here. Notice the price of this one, 520 bucks. All right, the other one was 515, the other was 505. Synthetically, they're pretty much alike because when I did these, Apple moved up maybe 10 or 15 cents, which affected a little bit of the bid-ask spread because there's so much liquidity in these. Here is an example using Apple again of an unbalanced butterfly. So typically, in a trade like this, now when I put this on, I just selected these strikes because I wanted to stay with the same strike complex. That could be all the futures associated or the markets associated in the energy complex. So what we're going to do tonight is, let me just go over just a little bit of a primer of metals in the energy markets, some of the key terms, and then what are the futures we're going to review tonight. We're going to talk about gold. We're going to talk a little bit about it. We're going to talk about the contract specifications, and we're going to take a look at the chart of gold and see what's going on there. We're going to go take a look at silver, and the same thing with silver and copper. So that would be considered the metal complex. Now, I'll show you in a minute. There's a lot of other metals that are in the metal complex, but these are the ones that are the most heavily traded. There are others out there, but the liquidity is not where you want them to be, so if you need to get out very quick, it's very difficult to do so. And then, of course, we're going to also talk about oil, which is considered the energy complex, natural gas, and gasoline. And these are the main three, and we've also got heating oil, but I really don't spend too much time in heating oil. The main three that generally have the most liquidity, that generally get the press, and you see it on TV, CNBC, and all the talking heads, is oil, natural gas, called nat gas, and gasoline. You'll hear the term RBOB gasoline. So we'll go into each one of these, each of the contracts. We'll look at the current charts of each one of these, you know, kind of the current action that's going on there. So, and remember, like I said at the very beginning here, I said earlier, what we're going to be talking about here, or this evening, in part one, we covered the indices, government securities, currencies, or I'm sorry, that was in part 2 and 3. Part 4, we're going to talk about energy. Now, you see up here Brent oil. I'm going to talk about the difference between Brent and WTI, and then natural gas, nat gas, and unleaded gasoline. And then in the metals, we're going to spend time in copper, gold, and silver. So that's where we're going to focus on tonight. Now, in the metals market, there's a lot of history that goes back in the metals market, and a lot of it has kind of served mankind for thousands of years, whether it's mercury, tin, iron, copper, silver, gold, and metals can really be traced back a long, long time ago. Some metals have a use and a utility in industry and business. Others have more of a jewelry appeal, store of value, portfolio hedge, and things like that. And you may be thinking, okay, yeah, fundamentally, I kind of understand that, but why is that important to me? Well, there are seasonal tendencies in commodities, and there are seasonal tendencies in metals. Gold tends to move up as you go into Q3 and Q4 because a lot of people, especially in the Far East, in Asian countries, Indian countries, gold is a very popular holiday gift. It's a very popular storage of value, as it is here in Europe and the U.S., but it also has that jewelry appeal. So it tends to move up at that time. January, February, March, gold has the seasonal tendency to pull back. Industry and business tends to find more usage out of the... Well, I hope you enjoyed what you just saw over the past 25 minutes or so. We do a number of these educational videos throughout the year. Our members find them very, very helpful in their day-to-day trading. We have a number of people that come in and just watch the educational videos only, but there's a number of different ways that you can participate with our user group. Our membership options include a number of different frequencies. So for example, if you wanted to join our user group, you could do it for an annual basis. You can become a member for a semi-annual or every 6 months, or you can check us out on a monthly basis. The annual membership is very popular, but so is the semi-annual and the monthly. Now, when you sign up, all membership options come with full site access, whether you're a monthly member, semi-annual member, or an annual member. And each of these include our ongoing weekly webinar sessions. We have sessions on Tuesday and Thursday. We call them our pre-market trading sessions from 7:30 to 8:30 in the morning, New York City time. They're all recorded, so in case you miss it, you're resource constrained or time zone constrained, you can come into our library and look at them anytime you want. And then Sunday evening for the upcoming week. So those are all included in the membership options. The other one is daily chat room access. We have a daily chat room, and you can participate in that chat room. We have a complete educational library that you'll have full access to. Again, whether you're annual, semi-annual, or monthly member, that's quite all right. And then, as I mentioned earlier, we have ongoing new educational webinar series that you can partake in, and we got a number of really cool ones coming up. We've got some on position management and then trade adjustments, and we've got some on calendars and a whole host of other things as well that I think are going to be very exciting. So how do you check us out? Well, at the top of this screen up here, you'll see a link. Just click on that button, go through, look at our special offers, check out the website, and I hope to see you guys on the inside. Otherwise, make it a great day and have a great trading plan that you're executing. Talk to you later. Hope to see you in our on our site. See ya. Bye now.